Okay. All right. So it's 2 o'clock, which means it's now time for Tax Talk Tuesdays. And I always like to come to you on Tuesdays to give you some information about what's going on with this new law. Let me make sure that the Facebook Live is on. If you are there, can you let me know? Can you let me know that you're there and that you can hear me? I had a little bit of trouble with my internet connection this morning, so I definitely want to make sure that you guys can hear me out there. So let me know if you can hear me. If you can just say in the comment section that you can hear me, that will be helpful. So I'll give you a couple of minutes just to make sure. Today, I want to talk about this new tax bill. I know we've been hearing so much about it. To actually roll into February, because some of the other information I gave to you earlier was much more important, I felt. So I see a couple of people have joined. Lakia, yep, thank you, Lakia, with Synergy Accounting. Thank you so much for joining. As you know, tax season officially opened yesterday. So if you are an entrepreneur and you need someone to assist you in getting your books and records correct before you take it to your accountant, you make sure you want to reach out to Lakia Bourne. Lakia, when you get a moment, if you could put your contact information in the comments section, I'm sure people will be reaching out to you. I see Nikki Siblis has joined. She's a phenomenal family law attorney. If you need any family law assistance, make sure you reach out to Nikki. Nikki, put your contact information also in the comments section. I see Brian Weaver, Warren McGill. Thank you guys for joining in. So I'm going to go ahead and get started because I'm really excited to be able to come to you and share with you this topic on this new Tax Cuts and Jobs Act. And the question is it really a Tax Cuts and Jobs Act? So to kind of recap what I talked about last week I talked about the issue of, the passports. And I know people know I love to travel, and I know some of my colleagues out there love to travel, but about 2 weeks ago, IRS announced that they were going to begin to deny passports to people that were considered seriously delinquent taxpayers. Who is a seriously delinquent taxpayer? If you owe $50,000 or more to the IRS, then you want to make sure you become proactive and get into some type of collection alternative with the IRS, because as of this year, they've announced that they will be working with the State Department to deny and in some instances revoke passports. So I wanted to make sure you had that information. If you missed it last week, you can go to my Facebook page and get the information, or you can go to YouTube. I'm on YouTube, or you can go to my law office fan page. So it's out there. All right. So let's talk about this Tax Cuts and Jobs Act. Today, I'm going to go through the provisions that strictly deal with individuals. And within the next couple of weeks, I'll share how it will impact businesses, sorry. So if you are an entrepreneur, or if you know an entrepreneur, you definitely don't want to miss the next couple of Tuesdays, because I'll be breaking down various parts of the new bill, the new tax law, and I won't say giving you some strategies, but I'll be discussing the ways it will impact you as an entrepreneur. So today we're talking about individuals, though. So individuals like me, and like some of you guys, obviously, that are on this Facebook Live. So I'm going to need my notes. I have notes today because there's so much information. There was so much that I had to that was in this bill, and I wanted to make sure I got you the provisions that I thought that would definitely help benefit you. And so as I go through this, I will be honest. I'm not the type of person that can just give you a straight poker face a lot of times. When I don't like something, then it normally like shows on my face. So what I decided to do was, as I go through this, some of the provisions, I'll probably just tell you, look, yes, thumbs up, I agree with this provision. If I don't agree with the provision, then I'm probably going to give you a thumbs down. I'll just be honest and tell you, look, I hate this provision. Okay? All right, so everybody's clear? All right. So I'm actually going to put on my glasses so I can be able to read some of my notes. All right. So one of the biggest changes to the tax, this new tax bill, first of all, it's called the Tax Cuts and Jobs Act, right? So one of the biggest provisions that they changed was the tax bracket. Under the old law, there were 7 tax brackets. They range from 10% to 39.6%. The new law condenses the tax brackets down to 4%. And they are 12%, 25%, 35%, and in some instances, 39.6%. So overall, the majority of people will fall into a lower tax bracket. I don't want to go through the actual income ranges because I feel like that's something that you can kind of easily look up. You can look it up online. But some of you may now begin to see some increased dollars in your bank. Well, if you are a W-2 employee, if you're working for someone, then the payroll companies, what they're doing now is, or your HR person is now beginning to submit the withholding calculators, which will give you in return some additional, maybe $50, $100, depending on your salary each week when you get paid, or bi-weekly or monthly whenever you get paid. So you may see some additional money coming back to you. What do you do with that additional money? I don't know. You probably want to save it or invest it. But that's one thing you should be aware of, how this impacts you. So that provision, I'll give a thumbs up. I actually like it. So in terms of the effect on capital gain and qualified dividend income, there was nothing that impacted the capital gains rates or the qualified dividend income. They're still between 0, 15, and 25%. Okay, so that's fine. I don't have any opinion either way. Let's talk about the standard deduction. So I'm sure by now you've probably heard that the standard deduction is doubled. It's been doubled. And to a certain extent, it actually has been doubled. So in the past, like 2017, if you were a single person and you didn't itemize, you got a standard deduction of $6,350. With the new law, you get $12,000. $12,000. So that's a good thing if you don't itemize. So a person who, I'll say this, it's good in the fact that if you didn't have a house and you didn't have mortgage interest or real estate taxes and you didn't give to charity, and you fell in that category where you paid a lot of rent but didn't get the benefit of your rent, but you didn't get to itemize, you had to take a standard deduction, this certainly helps you. For an individual who has the mortgage interest, the state and local taxes, then this may be whether it hurts you or helps you. It really depends on your own individual circumstances, so I can't really say anything about that. But one thing, even though they say it's double, one thing that they sometimes don't really tell you about is that you lose your personal exemption. Your personal exemption was worth $4,050. So for a single person, and a person that in particular has kids, then this is something that, in my opinion, it doesn't help them that they've lost their personal exemption. So, but one of the ways that the act actually tries to compensate for that, in my opinion, is that for people that have children, the child tax credit was doubled. Okay, so, and I'll go through that. The child tax credit now is $2,000. And they also will give you an additional $500 if you have what they consider a other dependent. So someone that you are taking care of that is not your child. You now get $500 for that. The reason why I like the provision of the child tax credit is because not only do they double it, but they also increase the amount of money that you can earn and still qualify for the deduction. Now, if you are a parent out there and you have kids, this is an awesome provision for you, because in particular in this area, under the old law, I hated the fact that, we have in Maryland, we have high income earners, right? If you're a married couple, then under the old law, you would phase out and not be able to take this deduction if you earned more than $110,000 married. In Maryland, Washington, D.C., a lot of married couples I worked with, they were hurt by this. They weren't able to get the benefit of the child tax credit. The good news is under the Tax Cuts and Jobs Act, they do get it if your income is under $400,000. $400,000, right? So for this, I told you I would give you a thumbs up for something that I really like, and a thumbs down. This gets a thumbs up. I applaud Congress for this provision. I feel like they really cared about the family in this instance. So that I like. So I see a couple more people have joined. Thank you, guys. I see a couple of people from North Carolina have joined in. That's Erica Ellis, Kevin Holder, Colleen, some people I grew up with. Thank you guys for joining. I see Lisa, who I went to Bowie State with, So thank you guys for joining. Do me a favor. If you hear something that you think may be beneficial to, someone please click the share button, because like I always said, it takes a village, so to speak, to raise a child. And, since we are talking about children, we want to make sure we get all this information out to the parents. So the other thing I want to talk about, now I'm going to move to these education expenses. Okay. There are a couple of things that happened with this new tax law when it came to education. One of the things is, let's talk about the Section 529. So the Section 529 plan allows you to save for college for typically your child that is tax-free. And upon distribution of the funds, you can it's not going to be taxable as long as it goes directly to a college, right? So the way this law is changed in 2018 is that you can now pay for elementary school and post-secondary school, which not only that, I forgot, homeschooling also. I am beyond excited. I mean, I'll give you definitely a thumbs up on this provision, Congress. Again, you heard the needs of the people and the parents, because this right here is just an awesome adjustment in this bill. I work with clients. A lot of my clients, they pay for private schooling. They pay for, homeschooling or tutoring, and it's a lot of money. I mean, I have clients that may spend anywhere from $15,000 to $20,000 a year for, their child to be in private school. So the fact now that they can take and put money into a 529 plan and then turn around and pay for the child's, schooling, to me is incredible. So if you have any young kids right now, one of my recommendations would be that, you go ahead and set up a 529 plan. I see Brent Simpson has joined the call. He's tuned in, and I know he's an awesome business strategist. But before he was a business strategist, I know he did financial planning. So if you're looking for someone who can probably direct you now to someone that can set you up a 529 plan, then Brent may be an awesome resource. Brent, if you don't mind, if you can just put your contact information in the comment section, that will be so awesome. And but he primarily right now is he's a business strategist. If you want to take your business from one level to the next level, absolutely, you want to connect with Brent, and he'll probably be joining me on the entrepreneur when we begin to break down the bill for the business and how it impacts businesses. So let's get back to the individuals. Okay, so the other thing, let's go back to itemized deductions. How does earlier I talked to you about standard deductions versus itemized deductions. All right, so the things that they changed in this new bill dealt with medical expenses. I like what they did. They took it back to where if your income exceeds, if your unreimbursed medical expenses exceed 7.5% of your adjusted gross income, you now can deduct it if you itemize your deductions. And the reason why I like this is because a couple of years ago, Congress did something crazy where they raised the threshold to 10% of your adjusted gross income. I thought that was ridiculous. So I'm glad to see it come back down to 7.5%. Okay. Now this is a provision I cannot even put a poker face on because I absolutely hate this. I hate this. I can go ahead and tell you I'm giving you a thumbs down, Congress, on this. The state and local property tax deduction. What you did with this is you capped it at $10,000. So a person who has state tax withholdings and a person who itemizes and has property tax because they own a house cannot take any benefit of what they pay if it's over $10,000. Why do I hate this? I hate it because it hurts people in high taxing states. High taxing states are states like Maryland, DC, New York, New Jersey, Connecticut, and a couple of more. But this absolutely hurts my taxpayer, my clients. So I'm giving you a thumbs down on this. I hope to see that this is something that will be changed, but I don't know. It will in the near future, but the future. I can't even say the near future, but I hate this one. The mortgage interest deduction. So what they did with the mortgage interest deduction is that everything stays the same except for if you are a new homeowner. If you are a new homeowner and you purchase a house that's $750,000 or more, you can only deduct the mortgage interest that is attributable to the $750,000 and less. So if you purchase a house for $1 million, then you won't be able to get the benefit of really about $250,000 worth of mortgage interest that you may be paying on. So in this area, it hurts because, DC, New York, New Jersey, a lot of people have, buy homes that are very expensive. And so they fall into that category. Charitable contributions essentially are the same. Let's see. Eliminated items that you will no longer see. Moving expenses, they got rid of. So let's say if I took a job in New York and I moved to New York, in the past I would be able to deduct my moving expenses. Not anymore. I can't deduct my moving expenses anymore to take the new job. So casualty and theft loss, they've eliminated the casualty and theft loss, except for if the president declares it a national, basically a disaster, a federally declared disaster, then you can deduct the casualty and theft loss. So if you are in some type of disaster area, you want to make sure you pay attention to whether or not the president is claiming that as a federally declared disaster. Miscellaneous itemized deductions. I hate this provision that they got rid of. So in the past, when you had expenses from your employer that were not reimbursed or not reimbursable, if your employer had some type of policy where they didn't reimburse you. So let's say my employer asked me to run a couple of errands or go, particularly if I'm a salesperson. If I'm a salesperson and part of my job is to go to various locations and try to sell products, then I typically in the past could deduct my mileage. Not anymore. You cannot no longer deduct your mileage. It's gone. Forget about it. If you paid a financial advisor, investment fees, a tax preparer, tax accounting to do your tax return, in the past you could deduct that. It's gone. I hate this provision. It's getting a thumbs down from me. Okay. Alimony. In the past, it was deductible to the person that paid, but income to the person that received the alimony. How I feel about this provision, I'm kind of, I guess, lukewarm on it because I don't do divorce law, so I don't know. But my assessment would be that it's something that the parties negotiated. So let me just kind of further explain what happens with the alimony. So the alimony for divorce settlements moving in 2018 forward, you can no longer deduct the alimony and it's no longer includable in income. Anything prior to 2018, your grandfather name. But there was one more thing. I want to go back to education expenses and then I'm going to get off. The other thing is discharge of student loan debt at death. That is now you can exclude as income if canceled after 2017 and before 2026. So those are the key provisions. These are some of the things that, Brent, you can't deduct mileage. You absolutely cannot deduct mileage. That hurts. That hurts. Trust me. I told my uncle he's retiring at the right time. So he's retiring in February because they got rid of his unreimbursed employee expenses. Nevertheless, I always like to give you my contact information. If you want to reach out to me, if you have some additional questions about some of the information I shared, you can contact me. My office is Law Office of Beverly Winstead. I am a tax resolutions attorney. I help people that have problems with the IRS typically, and I go to court. I also represent you in audits. So that's kind of the things I do. I also prepare tax returns and do tax planning for people, individuals, and businesses. So I can be reached at 301-306-1234, or you can email me at beverly@irshelpattorneys.com. In addition to that, I also run the tax clinic at the University of Maryland School of Law. If you are a low-income taxpayer, low income meaning that you make $30,000 or less for one person, a two-person household, $40,000 or less. If you have a child, and let's say it's a three-person household, $50,000 or less, make sure you reach out to us at the law school. That number is 410-706-3295. Again, 410-706-3295. I see Brent put this contact information in in the comment section. I see a couple more people joining that I know I went to Bowie State with. That's Rod Williams, Marco Cooper, Butch Tweedle. Thank you guys so much for joining in. And like I said, if there's a situation or if there was something that you heard that you think would help someone else, I ask that you just hit the share button. Like Dr. George Fraser says, grow, teach, repeat. Grow, teach, repeat. If I can say something that will help somebody else, then as my grandmother said, my life has not been in vain. So thank you guys so much for joining in. And remember, next week, I'm so excited that I'm coming to you. I'm going to talk about the business portion of the tax bill. In all honesty, now is the perfect time to get a business. So think about what you enjoy doing and get ready to file those articles of incorporation or articles of organization, because we're going to tell you how this is really a bill that helps people that have businesses. Thank you guys so much. Have an awesome week.